Hi everybody, this is Ketosis Trading. I want to talk to you today on how you can use the tick as a guide and as a means to enhance entry and exits on trades. So let's talk a little bit about what we have on this chart. Firstly, we've taken the tick index, which is on the New York Stock Exchange. It's based on all the stocks. They accumulate all the positive ticks, accumulate all the negative ticks. They subtract the negative ticks from the positive ticks. So when the ticks are above zero, means that the people are crossing the bids to buy at the offer, and when the ticks are moving to the negative side, it means that people are crossing the spread to sell stocks. So how can we use the ticks to improve entry and exits based off a given strategy? Okay, so firstly let's talk about the configuration of the chart. Okay, so we've got the tick on an open low high close, open high low close, sorry. We have a simple moving average of one period, which is going to give you the close. It's just a closing line. This helps to identify what's called tick hooks, which is something like this, where you start to see spikes, and then you start to see the ticks quickly turn around, and given that way as well, that's also a tick hook. Now also on this chart I've got what is called value charts landmark, which is an indicator which gives you overbought, oversold based off distribution. So distribution of price. In this case we're looking at distribution of ticks. Same principle, and it helps us to identify points where, based off look back period, that it's overbought or oversold, extreme levels. So you can see here, this point here, which corresponds to here, it was an extreme point on the ticks. It wasn't really extreme, but based off the look back period of here, you would say that that was extreme. Normally we would say anything above plus or minus 1,000 is extreme readings on the ticks. And how then can we use this to improve entry and exit on positions? So let me just clear this screen, and let's just scroll forward a little bit on the chart here. And let's just find a piece where it was quite extreme. Okay, so now I'm just going to grab my pen again to show you a few things. So now that we've got a couple of points here where we can have a look at, let's have a look at this point here where we touched 1,000. We got down here, which was minus 800, and then back up here, which was also plus 1,000. So that corresponds to this point here, extreme. That corresponds to this point here, and then this corresponds to this point here. So we're talking about A, B, C. So we're talking about, again, A, B, and C. So what we have here is a situation. How can we use this now to help us improve our entries and exits? So if we were long a trade coming into here, market was moving up, and we were looking to take profits and to exit positions, we can use the high ticks as selling points. So we would sell these high ticks. So you'd sell point A and sell point B if you were in a position. How also can you use these ticks as a means reversing as well? So we would buy extremes. So say you've got a trigger on your trading strategy and you want to buy. Okay, you got a signal to buy, but you see that the ticks are up around here, and you see them trending down, moving down, in this case like this. So you can say to yourself, okay, my signal is a buy, I'm going to wait a little bit. I can see that we've had a tick hook here up there, and I'm going to wait for some selling pressure, because the ticks look like as though they've peaked, and they're coming off. So you might wait and look for a better entry and not buy a high tick. So you'd be looking till you got to extreme ticks on the downside, which is negative 1,000. In this case here, you might sort of say, okay, this was an entry point to buy. We've got minus 800 on the ticks there. Okay, so let's scroll forward further, and I'll show you some more instances, because the market sold off heavily in the afternoon, and this was an instance where you could look for high ticks as entry points to sell. Okay, and similarly you can use the high ticks to sell, and you can use the low ticks to exit positions. So in the afternoon we started to see a sell-off, and as you can see here, we had started to get extreme ticks on the downside. So what you could do is, when the ticks got above 0, is an indication where you could start to sell. Anywhere from 0 to 400 was an area where you could see that the ticks weren't getting above that. So once it starts to pop up in that area, that was a good indication to, say, enter your short position. Then you could start to scale out when you're given your signals, when you start to see low ticks. Okay, so you can buy back in to your short position and close it out. Now lastly, I want to talk about how I also use on the ticks what I call, and what is known as, a linear regression channel. This is this thing here that you can see that gives you an indication of the trend of the ticks. So when that starts to give you an incline, you know that the ticks are rising. When it's a decline, the gradient, you know that the ticks are being sold off and the stocks are being sold off. So I use a 60-minute look back period on a linear regression channel and on 1-minute tick data. So I hope this helps, and stick to those stops, and we'll keep you posted next time.